Live from our studio in New York City, I'm Julie Hyman, that's Josh Lipton, and this is Yahoo Finance Live. With just 1 hour till the closing bell on Wall Street, here's what we're watching this afternoon. U.S. stocks seeing the latest rally slip away. All three major averages taking a big hit, while investors digest hotter than expected January inflation data that showed prices cooling more slowly than forecasts had anticipated. The Dow Jones Industrial in particular down by more than 700 points. If it holds, it'll be its biggest drop in nearly a year.
And meanwhile, Fed officials have been warning that more time is needed before rate cuts can begin, and today's data may have just reinforced that cautious view. We're taking a closer look at today's sell-off, and we'll give you insight into what this all means for Jerome Powell and the Fed.
Plus, earnings season rolls on. We get a closer look at the current state of consumers. After the closing bell, we'll hear from an analyst on Airbnb and Lyft to see how their latest quarter shook out. We've got all your markets coverage coming right up. All right, let's get you up to speed on the market action right here. Going to go straight to the Dow here and what we have seen throughout the course of the day. Let's go to the intraday chart here, Josh. And what we have seen is really a deterioration over the course of the day, which if you're a bull in this market, you don't necessarily want to see. You see it for the Dow, you see it for the S&P, which is at 1.9%, and you especially see it for the Nasdaq, which is the worst performer on the day. Perhaps not surprising because this group has been the most sensitive to the change in this number. Yields, right?
Yeah.
The 10-year yield, a huge upward move of 14 basis points today.
Yeah, of course. The context, though, here also important, Julie, because we've been in such a rally mode. I mean, how many times have you said the word record recently, right? And there's any number of strategists and technicians who were saying you were due for a breather.
Yes.
You were due for a pullback. Not to say, by the way, that they are bearish on the market. They're not. But they were just saying in the kind of near to intermediate term, you were due for a pause. And they disagreed on that. Maybe it was 5%, maybe or 10%. So if you were due for a pause, then you start thinking, okay, what's the excuse? What's going to be the catalyst, right? And maybe you got that today with that January CPI print. Yeah,
that CPI print changing expectations for when the Fed is going to be first cutting rates. You know, a lot of strategists are saying March not happening at all, which is basically what Jay Powell has said. But now we're seeing the expectations pushed back even further. Is it going to be maybe not even May, maybe June, maybe even beyond that? So that's perhaps the excuse. And here's the probabilities that we're looking at here. So this is the probability that we will see any kind of cut at these meetings. And obviously you see the numbers gone way down from March. I don't know who's still looking for a cut in March. About a third, 30% probability, but these numbers are changing very rapidly here, but only looking at about a 50-50 chance of that cut in June. So it's evolved quite rapidly here.
You know what, listen, Fed Chief Jay Powell could not have been much more clear with you, I don't think, at that last meeting when he said, we are going to be patient, we're going to take our time. He basically said, listen, I like when I'm seeing inflation, but I need to see more. I need to see more good data. And maybe what you got today with that CPI print is kind of just confirmation of Powell's view.
Right, exactly. It's not showing enough of alleviation of the pressure here. We've got real estate stocks down the most today. They're quite interest rate sensitive, as well as consumer discretionary and tech. But everything, as you can see, is in the red. And just before we let you go, I want to look at the Nasdaq 100 in particular. A lot of these ripping momentum stocks, the Magnificent Seven, they are all down in today's session. And even if you equal weight this, you see just how much of the Nasdaq 100 is red. Only 3 stocks in the Nasdaq 100 green today. Let's get more in today's market sell-off and what to expect moving forward. I want to welcome in Jim Smigiel, SEI CEO. Jim, it's good to see you. What do you make of the sell-off that we're seeing today, and is this an appropriate response to that CPI data that we got this morning?
Well, Julie, Josh, thanks for having me. I think this is what to make of it is really the market pricing out perfection, because that's certainly what was priced in. I mean, where we look at where we ended 2023, the setup that we had in January, all these normalization cuts, the Fed's going to be able to come in and lower rates just because inflation is going to make its way almost on a linear path back down to the target level. And we've had the trifecta in recent days. We've had stronger NFP, we've had stronger GDP revisions, GDP now running over 3%, and now finally today with stronger than expected CPI. This is not going to be a linear path. This is going to be a bumpy road. And I think investors are just trying to take that in and realize, well, what does that mean for rates, for interest rate sensitive sectors, and for interest rate sensitive individual names like the ones you were just showing.
And Jim, I'm just curious, I was just talking to Julia, if you heard it, there were listen, plenty of smart strategists, technicians, Jim, who were looking at this rally and saying we're due for a breather, and maybe this CPI print was the catalyst we needed. I'm just curious, Jim, if it makes sense to you here, kind of the pullback we're seeing, or do you think this is the start, maybe, Jim, of something more serious for the equity market?
I think it definitely makes sense. I mean, the market was absolutely overbought. There were certain parts, names, sectors that were well overbought. Whether this is a harbinger of things to come, that is the start of a bear market, not necessarily. We wouldn't be surprised, however, if this is kind of just the start of the retracement or retrenchment, if you will, in a lot of these really overbought or most loved parts of the market. So, the economy is going well. The consumer is holding up pretty well. Earnings season, quite frankly, was very, very good. You could say maybe guidance was mixed. We're about 75% through earnings season, and I think that's really a kind of a green light for the market. So what we would say is we would look forward to more broader participation from equities kind of going forward, and we certainly wouldn't look for kind of an echo of what we saw in January with that really, really narrow leadership kind of coming through. The challenges, though, are where the yields go from here. If we recall last year, when we started creeping a lot closer to 5%, things got into a bit of trouble. So how stubborn is inflation going to be from here? If we do revisit 5% on the 10-year, our outlook could certainly change. And this could turn into a sideways to down market from here on out.
So do you think we'll get to that level, though?
I think it's quite possible. It's something that we've been calling since the end of the year. We saw the risks, the yields of being very symmetrical when I think the market really was loaded up on one side of the boat, that yields were only going to go down from here. The market, as you mentioned earlier in your preamble, March is basically off the table. When we look at probabilities, the only thing over 50% is June. So first cut now expected in June. And importantly, less than 100 basis points of cuts are now priced in. Josh, as you mentioned, we're getting closer to the Fed. Fed had 3 for 2024. The market was closer to 6. Now we're getting closer to 3. But what is it going to take to get there? I don't think the Fed is going to be in any rush. There's a lot of things going on geopolitically as well, where this could be an even more volatile CPI as we get month after month after month. Goods inflation may be something that we may be revisiting, quite frankly, with the troubles in the Red Sea and the increase in shipping costs. So do I think it's a huge stretch to have ourselves test the 5% level on the 10-year again? No, I really don't. I think that's definitely within the realm of possibility, certainly more so than what the market is expecting.
And Jim, I just want to, I'm looking at the major averages here. Nasdaq's down 2.3%. Jim, I'm just curious to get your take on tech specifically, Jim, because listen, you get a hot CPI print, rates higher for longer. That's not great news for high multiple names, Jim.
It certainly shouldn't be. I mean, this is just how discounted cash flows work, right? When we're expecting long durated cash flows out into infinity, and we have interest rates rise. When we discount those back, that should produce a lower net present value. So we tend to agree. Now, as it relates to the Magnificent Seven, that always hasn't been the relationship that has held. So we certainly want to recognize that. But that concentration in the first part of this year has been pretty extreme. And I think we all know the numbers. NVIDIA is up 45% on a year-to-date basis, and we haven't even seen earnings yet. That's a big release that everyone's waiting for next week. But directly to your point, we would expect if the economy settles in, if inflation doesn't reaccelerate, even if it's stubborn, we would expect broader participation here. So what does that mean? Value stocks is something that we like, and we are leaning back into and leaning away from the growth names. That's going to lead us to sectors like financials and energy and materials. So this overhang of the potential for higher rates, that is something that is it goes into our calculus, and it has us liking value, liking financials, liking energy right here.
Let's dig into energy a minute in particular. And value has been unloved for a while, and we get people periodically come on to say we like value, and it just hasn't quite broken out, right? Growth has continued to be the winner. What is going to change, particularly when we talk about energy here? Because those companies have been making a lot of big moves in terms of consolidation, but we have not really seen the stocks be rewarded.
Yeah, I think that's exactly right. I mean, one caveat on value, 2022 was a phenomenal year for value. So, well, although you're certainly right. If we look back 10 to 15 years, it has not been a great time. This has definitely been a time period of overactive monetary policy, and growth names have ruled the roost. As it relates specifically to energy, a lot of this comes down to supply and demand. If we have an economy that is holding its own, which it certainly looks like it is here in the United States, we have the potential for increased Chinese stimulus coming from that part of the world, another major economy that's been very, very disappointing, potentially coming back online. And then we still have cuts in production coming from the likes of Russia and coming from the likes of Saudi Arabia in April. So if the demand side can hold up and the supply side is going to continue to be constrained, that in and of itself, and that's just ignoring the geopolitical situations that we have in multiple parts of the world right now, that alone can be a bit of a tailwind for higher energy prices this year.
Jim, it was great to have you helping us kick off the show today. Thanks so much for your time and insight.
Thank you both.
Inflation data out this morning signaling a widening gap between the cost of dining out and for groceries consumed at home. With more on what's driving those inflationary pressures, we've got Yahoo Finance's Brooke DePalma. Brooke.
Good afternoon, Josh. I mean, certainly grocery prices are something that we've been watching for the past, 3 years? It sure feels like it's weighing on Americans, but certainly that cost to dine out actually outpacing the rise of inflation when it comes to the food segment of the CPI report out today. And largely what we're seeing here is labor inflation running ahead of commodity inflation. And that's causing the rate of inflation for dining out to continue to rise. And what's really pressuring here right now is this limited service menu prices within this dining out category. That segment alone within the CPI report jumped 5.8%, largely driven by, once again, labor inflation. And last month, at the start of the year, we saw 22 states raise their minimum wage. Florida, Nevada, Oregon, they're also expected to raise their minimum wage later on this year. And we're also keeping a close eye on that FAST Act. That's set to go into effect in California on April 1st. That will raise minimum wage there up to $20 per hour. And so when you think about this rise of cost of food, this labor inflation really weighing on that. And that's why Americans are maybe thinking twice about dining out.
Yeah, definitely, especially considering where they are in the income spectrum,
Absolutely.
right? Maybe lower income consumers being hit. The McDonald's CEO had talked about that trend. Yeah. So the cost of dining out has continued to rise, but we've also been starting to hear from a lot of food companies about what's going on in terms of consumer demand. What are we hearing?
Yeah, well, this has also been a hot topic in this past earnings season. Restaurant Brands International CEO saying this morning they're not really seeing a behavioral shift, but we also know that they're weighing into value. They're out with that 2 for $6 Whopper in select markets. But, as you noted, McDonald's saying that people are lower income consumers are pulling back on transaction sizes. We heard from Starbucks. They're also saying something similar. But something I'm really watching today in particular is the CPG brands have both a presence in store and in dining. And what we're hearing there is that consumers, they want this experiential economy post-COVID. And James Murphy, Coca-Cola CFO, telling me over the phone this morning that coming out of COVID, it's created this sort of tailwind for the company in terms of off-premise dining. What they're really seeing here is this rise in demand there. CEO of PepsiCo saying something similar last week, this pivot to away from home. And so as you can see here, James Murphy really expecting that demand for off-premise, think movie theaters, think those concerts that we hear so much about last year, really being a boost to the overall portfolio as well.
Interesting. Brooke, thanks so much. Appreciate it. Meantime, the White House is blaming so-called shrinkflation for higher consumer prices, calling out snack companies for contributing to the problem. And President Joe Biden, in particular, talked about brands in a video online.
When buying snacks for the game, you might have noticed one thing. Sports drinks bottles are smaller. A bag of chips has fewer chips, but they're still charging it just as much. I've had enough of what they call shrinkflation. It's a ripoff.
So as we know, this has been an issue that has bedeviled the president. Yahoo Finance's Rick Newman has watched it closely. Hey, Rick, we've talked a lot. I mean, everybody knows this we've seen evidence of this shrinkflation, I think anecdotally, many of us. But is this going to be the way that the president is going to change the narrative on inflation?
Yeah, if you can't sell voters on your foreign policy or your domestic policy, complain that you're not getting enough Doritos. Why not? And your Coke is too small.
I mean, it's relatable.
I guess I would like to see the video of Biden sitting around watching the Super Bowl, with his paw in a big bowl of Doritos or whatever. Maybe that would be more relatable. But what's going on here is the Biden campaign's message for now on inflation is it's not the president's fault, it's big corporations' fault. So that is where he's going to be trying to explain away inflation that is still too high. I mean, food inflation, the numbers today, it's still up there. It's still, and if you just go back the 3 years that Biden's been in office, I mean, food has gone up in price by way more than incomes has gone up. So has rent. Those are the staples people buy. So, nothing has really worked so far with Biden trying to explain this. I mean, what he's been doing up till now, he's been saying, well, all these things are going really well in the economy. Job growth is great. Employment is great. But we have more work to do. And then he says it's prices. Well, now that has not budged his approval rating at all. So now he's going to try to blame it on big companies. I don't think it's going to work really, but it seems like something they might try, see if they can get any traction on it, and then try a plan B or a plan C or a plan D if that's the way it goes.
And Rick, what's interesting, I was reading that how shrinkflation videos, Rick, have been trending on TikTok. I did want to get your take while I have you about, sticking with the TikTok thing, Biden campaign on TikTok, right? And I sort of get the strategy there, Rick. You're kind of going where those young eyeballs are. At the same time, there are security issues with this app. There's a reason, Rick, it's banned on government-owned devices. I mean, what do you make of the Biden campaign going on TikTok? Should we just think of it as kind of a win for TikTok's lobbying efforts there in D.C.?
That's a good question and a fair one. Right. So the Biden campaign is very worried that the oldest president in U.S. history and the oldest person ever running for president is not going to get enough of the youth vote. And that is a legitimate concern. I mean, there are people who feel that Biden kind of misled them by saying, I'm going to cancel student debt. And then he didn't do it, or he tried. But the Supreme Court basically said he can't do it. So Biden gets an A for effort on that, but he gets kind of a C for results. And I'm not sure young people are paying attention to exactly why it hasn't happened and things like that. So, yeah, Biden needs he doesn't just need the young vote. He needs young voters who might support him anyway to show up and not be alienated. Is going on TikTok going to work? I don't think so. I mean, I watched his first video. It seemed kind of ham-handed. Kind of like the thing we just watched with the complaining about shrinkflation. But I don't know. I think the thing we're all waiting to find out here is, does Taylor Swift weigh in? That would have a much bigger impact than anything Biden does on TikTok.
When that news happens, we'll break it here, Rick. Thanks. If it happens, thanks so much.
Yep. Bye, guys.
Bye. We're just getting started here on Yahoo Finance Live. Let's check in on the market sell-off here, holding pretty steady. In fact, the Nasdaq in particular, all three major averages have taken a little bit of a leg to the downside, even in the past 15 minutes or so. The Nasdaq now down 2.4%, the S&P off by nearly 2%, and the Dow off by 741 points. That's a drop of 1.9%. This as we see interest rates rise and a broad market sell-off in the market today. We've got much more coming up right up to the closing bell. Keep it right here. Well, despite the market sell-off today, as a whole, the start to 2024 has been a bullish one. Is the rally about to turn? Seasonality graphs predicted a lot of outcomes for 2023, and if we use the same tools, the latest graphs indicate we would be in for a dip. Jared Blickry has been looking into it, of course, so maybe beyond just today then.
Maybe beyond just today. I was looking at some weakness in semis yesterday, but guess what? At the beginning of the year, we had a map, and I'm going to show it in a second, but this is just the average returns by month. What you see here, what I want you to notice for February is that no matter how you slice and dice it, going back to 1949, fourth year of the presidential cycle, Democrat in office or not, you get negative returns. So I wanted a little bit more granularity. This is a model that I was using last year, produced very good results, and you can see it's largely bullish through July, through mid-year, and coincidentally, that's when we faltered last year for a few months, and you can see it picks back up in September, October into the year. Then you got that maybe Santa Claus rally. But not to get too far ahead of ourselves, I want to focus in on this little downdraft right here. This is mid-February to end of February, and there are a couple different ways of looking at it, but this is one of the potential turning points, and this would actually coincide with the downdraft that we're seeing today. Now, here's a totally different look. This is the average of VIX, so when it's going up, the VIX is going up. That means stocks are going down. We have a very similar seasonal pattern here from mid-February to early March this time in the VIX. And if this occurs, and it's starting to happen today, we're starting to see the VIX head higher, this would just mean that we're probably in or just taking what's due to us due to come. Now, I want to close here by showing this is a map of the S&P 500 in purple versus CPI days only. This goes back all the way to the beginning of the pandemic. And you can see CPI days largely track the general market, but we have not had a big downdraft on a CPI day since the very end of the bear market that ended last year, or actually 2022. So could this be a sea change? Potentially. At the very least, I think we're looking at some short-term weakness into the end of the month.
Jared, thanks so much. Appreciate it. We move on. 5 analysts have now raised their price targets on NVIDIA this year following a red-hot rally for that chip powerhouse. UBS and Mizuho are the latest to boost targets ahead of earnings next week. It comes as the rest of the semiconductors painting a mixed picture in today's trade. Here with more on this is Ben Beharin, CEO and principal analyst at Creative Strategies. Ben, it is always good to have you on the show, my friend. And let me just dig right into NVIDIA. You know, Ben, listen, obviously we got the sell-off today. NVIDIA is slipping a bit in today's trade, Ben, but just pull back the chart. And what a move this name has made, Ben. You're up about 230% over the past 12 months. It's up, Ben, about 40% already this year. Does that kind of move, does it make sense to you, Ben?
Yeah, I think again, right, you're looking at a company that's likely going to 2x revenue this year, if not more. Projections going into 2025 seem equally as strong. And we're in this cycle where we just have so much demand for compute, and in this case, GPU compute, thanks to AI, and not enough supply. And so when you hear about what NVIDIA is trying to do to secure more capacity, to try to make sure they can sell more GPUs and get to the market what they want, the software market, what they want to keep advancing AI, you realize we're up against these limits of really supply, right? Not necessarily demand. So it feels like that's not going away anytime soon. It may eventually, but it doesn't look like that's on the short-term horizon. And you have a lot of that optimism really priced into their valuation at the moment.
Ben, it's Julie here. When I look across the chip landscape, NVIDIA certainly, it's been surprising to some extent that it's continued to rally and that there are such expectations baked in. But an even bigger surprise has been ARM. And just even with the drop that we are seeing in those shares today, the pullback, it's up some 60% plus since its earnings last week. What is there I know there's small float there, but is there just sort of a desperation on the part of investors to get in on AI or to get in on the next big thing here? What's going on?
Yeah, I mean, I think, again, when you look at all of these valuations, like we can debate really, are they worth their multiples? I think a couple things changed with ARM in the recent, call it 3 to 4 months. I think the shift in business model that they bring about in terms of both how they license as well as how they're monetizing new IP blocks and well as how those new IP blocks over the course of time get monetized is far more clear now than it was when they were a public company many, many years ago. And so I think people got really excited about the value value upside of how their business model changed, and really the cycle of bringing new licensees on and monetizing those licensees with new IP, new product innovation year over year in light of this AI story as well. But really, a lot of their growth in terms of that earnings wasn't necessarily to just AI. It was just what they were doing around all of their new IP blocks. So I think there's a shift in sentiment toward understanding their business model and their upside more. Whether we, that's at its current valuation, I think is a big debate. But I think the clarity in their business model has helped sentiment a lot.
And Ben, stick with the AI theme. I want your take on this piece, Ben, in the Journal today that made some headlines, got some attention. And basically, Ben, it was looking at Microsoft's Copilot, so its new AI assistant. And I guess the bottom line of that piece, Ben, was, it's useful, but often doesn't really live up to the price. What did you make of that?
Yeah, I think there's two parts of this, right? The first is we're still really in year 2 of everybody figuring out what AI is going to mean in a corporate and a productivity context. There's also a lot of competition, right? It's not just Microsoft. You've got a whole host of companies out there offering ChatGPT like services that go beyond generic stuff into fine-tuned corporate models. So there's more questions to the market about how are they going to use this? What is that ROI going to be? And that's the exercise from all CIOs and CSOs that we talked to today, are just trying to figure out how much productivity gains they need to justify the current economic investment for now. Again, those prices will come down in terms of infrastructure over the next couple of years. But with where we're at right now, the real big question is just what are those productivity gains that you need to justify the cost? And every business is just going through that exercise as we speak.
Ben, of course, all these companies that we're talking about are rolling over today, along with the market overall. Higher rates on the back of that CPI report this morning are the culprit. And what is the risk level, and how do we assess it, that we'll see a repeat of what we have in the past, where you see tech really start to significantly decline as rates rise?
Yeah, I think there's always that risk, right? And I think there's a couple of names that just in semis particular and in big tech that are somewhat isolated to that. And I'm going to put them squarely in that camp of companies who just have far more demand than we're going to see supply through the semiconductor supply chain. And over the course of that time, they're going to continue to have very, very good financials, strong sales, and a ton of demand, right? Outside of that, there's lots of other levels where I do think there's going to be risk, because again, you risk those sell-offs. I think the big question is going to be how fast will those things recover, especially, again, anything with an AI-ish label has what I can best describe right now as outsized investor expectations. I don't know if those are exactly level set right in line, but there's just so much optimism for that right now. At the same time, it does feel somewhat bubble-ish, but to the degree of that, I don't know. So there's always going to be inherent risk of repeating this cycle of what happens with these kind of early bubbles of a mega cycle, this one being AI.
Yeah, well, we'll be in touch as it goes on, Ben. Ben Beharin, great to catch up with you. Thanks so much.
Thanks for having me.
Coming up, we're checking in on some of today's top trending tickers, including shares of Waste Management, which is riding higher after an earnings beat. We'll be right back. Let's check in on a few trending tickers, and we begin with Walmart and Vizio after the Wall Street Journal reported that Walmart is discussing a deal to purchase the TV maker Vizio for more than $2 billion. The Journal saying the deal might not end up getting done here, but it's a way potentially for Walmart to lean into consumer data, to its ad business as well, which it's been growing. But an interesting and maybe surprising headline.
Yeah, I think it's interesting. It's about one, yes, growing that ad business. Walmart did about $3 billion in ad revenue for the previous 12 months. But to your point, Julie, I think you're right. It's also just about data about shoppers, right? I mean, Walmart obviously competes with Amazon, which has a ton of data about its customers, what they like, what they don't, when they buy it, when they don't. Incredibly useful, and Walmart would certainly like the same.
And I didn't realize this, that data on TV ad sales is owned by whoever operates the TV operating system, or whoever owns it. So that's why it would be valuable. Just one quick thing here. Vizio down quite sharply from its IPO, which it had in 2021. It was at $21 a share, opened that day at $17.50, and now it's trading, well, it's rising today, but it was trading around $8 a share before these headlines broke. So Walmart, you could argue, would be getting it at a lot less than it would have.
And Walmart, by the way, remember, reports next week. Maybe we get some more color and commentary about this.
We'll see. Vizio on February 27th.
There you go. Moving on to another ticker making news today. Shares of Boeing lower after the CFO said the company will ease its production rate of the 737 jets, just 38 aircrafts per month for the second half of 2024. So this one was interesting. That was the news, that Boeing plans to kind of build its 737 MAX aircraft, I guess at a slower pace, Julie, during the first half of this year. That's according to the company's CFO. And the FAA had said, remember, Boeing isn't going to ramp production rates until regulators actually feel good about that quality improving. So maybe not a total surprise here.
Yeah, no, I mean, definitely not a total surprise with everything that Boeing has been through. The pace that Boeing had established sort of by the end of last year was 38 a month.
Right.
And so we know now that it looks like this is going to be lower than that. We'll continue to monitor what regulators are telling the company and how this is affecting how they do in terms of production and sales.
Yeah, and for investors, the CFO did say Boeing is still confident it can hit, Julie, annual cash flow targets of around $10 billion in that 2025, 2026 timeframe. But I mean, the stock's down today, down about 20% now already this year.
And getting to another ticker that's trending today. Shares of TripAdvisor higher after the company said it had formed a special committee to evaluate any potential offers to buy it. This comes following interest from Liberty TripAdvisor, which owns 21% of the stock, and said it was evaluating potential alternatives for the company. So Liberty TripAdvisor, the controlling company, and basically had now announced they were forming this special committee here. It's interesting when you look at who could be buying the company. It doesn't seem to be there's a lot of broad agreement as to who would be a logical buyer.
Yeah, and in fact, Reuters is saying Liberty TripAdvisor has been approached by at least one bidder for its controlling stake in TripAdvisor. That's according to Reuters, citing sources, but the identity of that party could not be learned at this time, Julie.
And finally, waste management.
Let's talk waste management, WM.
Yeah. Let's do it.
I'm sorry, that was my turn. Yeah, that's what
it's
you're saying.
your turn.
It was kind of a dramatic pause there. All right,
Let's talk trash, Josh.
That'll do it. That gets the eyeballs. Climbing in today's trade. Let's get to reports. Q4 adjusted EPS beat estimates. More importantly, full year adjusted operating EBITDA guidance, that beat consensus at the midpoint. So 6.28 to 6.43 billion. That's what they gave the street. The street was at 6.32 billion. Looking ahead here, companies saying in 2024, Julie, they're talking about the anticipated financial performance being driven by disciplined pricing, operational efficiencies, and prudent cost management.
So apparently it's the collection and disposal business that is doing well here. And you think, well, isn't that what they do? Well, they do a big recycling business. They do other types of businesses. So it's sort of their bread and butter, it sounds like, that's doing well here. And the company is also going to be investing, however, in its recycling and renewable energy business because they generate energy from some of their trash as well.
Yeah, all things trash.
It's cool.
Tremendous insight.
I like it. Very Oscar the Grouch segment.
It is. That should have been. Yeah, that's a good production. Now you get that on a full screen, you got something. All right, moving on. Shares of Pinterest and Snap both struggling to gain back ground after last week's steep post-earnings fall. Some investors now wondering if these two companies can survive today's tough digital ad market against giants like Meta, Google, and Amazon. For more on this debate, we bring in Cameron Ansari, Headline venture partner and former head of corporate development at Pinterest. Cameron, it's always good to see you. So let's talk these two names, Cameron. Pinterest and Snap. Not a great start to the year for either one of those names. Some people may be asking, Cameron, listen, you look at these performances, can they actually survive as standalone companies? What do you think, Cameron?
Well, I mean, you guys talking about waste management, you're talking trash. It's it makes me think that we're, here in San Francisco, we're talking about innovation and tech, but the simple businesses sometimes do the best. So, Snap and Pins have both been, under pressure in the last, several quarters. I think that they're two very different companies. I mean, Snap at this point is a $4.5 billion top line business, a very sizable business, but not really growing. Snap has been flat the last year or so. If you look at their 2022 revenue versus 2023, essentially identical. And they're still losing quite a bit of money. I think they lost something like $1.3 billion for the year. Meanwhile, Pinterest is growing a little bit, more handsomely, about 10%. They did about $3.1 billion for the year in 2023. And they're starting to kind of eke out a profit now. I think they turned a minor profit in Q4, and for the year, we're about break even. So, I think they're different companies, but also very different use cases. I think Snap competes much more directly with TikTok and Instagram, which at this point are just so formidable. Whereas I think Pinterest itself has a little bit of a different swim lane in discovery and search and commerce. So hopefully they can kind of carve something out there that's unique for them. But I think both companies are going to have to figure out, are they large enough businesses to be viable standalone companies when you have these Goliaths like Meta and Alphabet and Amazon out there?
Well, what do you think? Will they be? I mean, let's take them one by one here. Are these going to be independent a year, 3 years, 5 years from now?
So when LinkedIn got bought, that was the last kind of business of this size in the kind of digital media, social media universe. That was bought by Microsoft in 2016 for about $26 billion. At the time, they're doing about $2.5 billion in revenue. Today, LinkedIn does about $15 billion in revenue, so it's almost 5x since the Microsoft acquisition, which is, I think, a blockbuster deal for Microsoft. Once that company got bought, it always said to me, at the time I was at Pinterest, if they're not large enough to be standalone, then are we or Snap or these other companies big enough to be standalone? Because LinkedIn, we looked at as being a very sizable asset, and there is a sense that the bigger companies seem to be having more gravitational pull, kind of the Death Star kind of thing going on, where if you're an advertiser, you have $1 to spend, would you rather spend it on Meta or Google or Pins or Snapchat? And I think people tend to prefer to go to the kind of larger platforms with whom they've worked more, heavily in the past, and they just have larger audiences. So I think that's a trend that is definitely happening. I do think there's still a place, particularly for Pinterest, because I think I know that business a little better, and I think it does have its own kind of unique profile. Snapchat to me seems a little bit more vulnerable to potentially getting bought, and of course it was almost bought by Facebook, several years back for about $3 billion, which they turned down.
And Cameron, while I have you, listen, we got a market sell-off here. Got the Nasdaq down more than 2%. You know tech investing, Cameron. I'm interested to get your take. There's some viewers right now who will be thinking they saw that hot CPI print, Cameron. Rates higher for longer, not good news for high multiple names. Is that how you see it, Cameron, or no? Is that sort of just short-term thinking? And those with a longer-term horizon, you still want to be in these names as a kind of smart plays on that big, broad, secular AI trend?
I tend to agree with the latter. I mean, I think this is, in the short term, you're going to see choppiness for sure. And I think you saw a big run up the last few weeks and months. Last couple of days today, you're seeing a sell-off, 2% down on the Nasdaq. Obviously, Snap and Pins have been down significantly in the last week. And so you're going to see, I think, this kind of back and forth until the interest rates settle down, until the CPI settles down. But I think if you zoom out, 2, 3, 4, 5 years, technology and the innovation that's coming with AI, and just with the growth of these names, particularly in markets, you sit here in the U.S. and you think these are such household names, but there's so much headroom for these companies overseas, particularly, Pinterest and Snapchat at this point, I think have 80% of the users outside the U.S. That I do think in the long term, you're going to have good growth in these assets, along with all the mega cap names as well. But in the short term, there's going to be some pain to follow, no question.
Yeah, it feels that way, especially on a day like today. Cameron Ansari, good to see you. Thanks so much.
All right, thanks. Take care.
You too. Coming up, we're joined by the CFO of Zoetis. It's the world's biggest animal healthcare company. We're going to dive into its latest quarter next. Animal health company Zoetis, the share's taking a bit of a hit in today's trade after a mixed fourth quarter. Looking to the year ahead, the company, which makes medications for both pets and livestock, emphasized confidence and sustained growth on its earnings call thanks to the range and diversity of its product offerings. We're joined by Wetteny Joseph, Zoetis' CFO. Wetteny, it's great to see you. Thank you so much for joining us.
Julie, thanks so much for having me on your show.
So I want to get right to it and talk a little bit about the reaction that we're seeing in the shares today, which do seem to be in part due to the fourth quarter, in part due to the forecast, some concern around clarity around margins. What do you think, as you see the stock reaction, do you think the street is getting it wrong here, or what message would you want to give to investors?
Look, Zoetis is the global leader in a very resilient and essential animal health industry that's proven to grow across different economic cycles. We're very pleased today, actually, with our top line growth for the quarter, which is 8% operational growth. That's the third straight quarter of 8 or 9% operational growth in a row, fueled by our companion animal portfolio with innovative products across the world. So we're very pleased with that. Now, when you get down to the bottom of our P&L, we did see some impact from foreign exchange, particularly in the hyperinflationary markets that have an outsized effect on our results, bottom line results, as well as a non-recurring item, which was an impairment of a small acquisition in our precision animal health space. But the fundamentals of our industry remain strong, and we exited 2023 with momentum and actually issued guidance for 2024 today that has 7 to 9% operational growth at the top line and 9 to 11 at the bottom, which means we are looking forward to expanding our margins and growing the bottom line faster than the top line.
And just to dig into the results that you guys posted today, dig into the segment. So livestock revenue beats, companion animal revenue looks like it clocked in at $1.45 billion. So it did just miss the street's estimates. Any kind of puts and takes there for that segment that maybe the street wasn't aware of? And what's your outlook for that segment for the rest of 2024?
Yeah, Josh, look, companion animal was 10% growth on the quarter, which is the third straight quarter, again, a double-digit growth in companion animal. As you know, our business is 2/3 companion animal and 1/3 livestock. We're very pleased to see livestock grow this year at 6%. I'm actually here in Salt Lake City, Utah, where our sales team is having their national sales meeting for the year. Very pleased and really seeing the momentum that we have coming out of 2023 going into 2024. But companion animal, third straight quarter of double-digit growth. And our guide actually implies that companion animal will continue to be the key driver of our growth in 2024 to deliver that 7 to 9%. So with livestock being a third of the business growing in the low single digits, that's in line with the market. That leaves companion animal essentially growing double digits as we go into 2024. So we couldn't be more pleased with that. And it's really driven by our broad portfolio that we have, lots of diversity across the business, both in geography as well as across species and therapeutic area, but also fueled by innovation. We have groundbreaking innovation like Librela and Solensia. These are all a pain franchise that just launched in the US in the fourth quarter, and we're very pleased with the results so far. And this is the next billion-dollar franchise for us at Zoetis.
That's right, Librela for osteoarthritis, for folks who aren't familiar. For the companion animal segment, where are you seeing the biggest demand here? I mean, we love our pets, particularly here in the US, but obviously have a big global business as well. So what's the most acute need for pet owners for their pets' health?
Pet owners actually see their pets as members of their family, and that human-animal bond is undeniable. 95% of pet owners consider the pets a member of their family, and so they're demanding higher quality pet health care for those pets, and they're willing to spend on them. In fact, 95% of pet owners see them as members of their family, and if they were faced with a 20% decrease in their budget, they wouldn't reduce how much they spend on their pet healthcare. So as we look at the space today, we see broad-based growth across the different therapeutic areas within companion animal, and we see significant opportunity to continue to really meet unmet needs in the space, be it across cardiology, whether it's renal. Chronic kidney disease is a particularly difficult disease state for veterinarians to treat. And so we see those as areas that we see significant opportunity as we look ahead. That will be the next billion-dollar markets that we will go after.
And one big theme for investors this earnings season has been China. So I'm interested to get your take. How is business there, and what do you see in the quarters ahead?
Yeah, look, China is under 5% of our business, of our revenues. And we've seen economic pressure in China, and we expect those to continue through at least the first half of 2024. However, long term, we continue to believe in the potential for China. And over the last decade, our revenues in China have grown significantly, and we expect that to be the case as we look on the long-term horizon. But for now, the consumer sentiment in China, as well as some really difficult comps that we have coming back from last year, will continue to put some pressure on the numbers for China. But we look forward to continuing to see the long-term prospects that we expect there.
Whitney, thanks so much for joining us today. Really appreciate your time.
Thanks so much, Josh and Julie.
The $1 trillion market cap club could soon be getting a new member, and it may not be one of the Magnificent Seven. That's according to our next guest, who's been following the progress of one iconic name that could soon be adding a few more zeros. Let's have market reporter Paul LaMonica reveal who it is. Paul, who is it?
Berkshire Hathaway, yes. Warren Buffett, not exactly known as the most savvy tech investor, despite a big stake in Apple, of course. But this is a company that now has a market valuation of about $860 billion, so not that far from $1 trillion.
Hey, Paul, it's Julie here. First of all, it is fantastic to see you. Secondly,
thank you.
As we look at Berkshire's portfolio, right? We know Apple's a big part of it, but what sort of has powered the latest growth leg for Berkshire Hathaway, and what could then power the next leg?
Yeah, it's very interesting, Julie. Apple, of course, is by far the biggest stock in the Berkshire portfolio. So that is helping to propel the gains of the investment side of the business. But remember, Berkshire Hathaway and Warren Buffett and the late Charlie Munger were known for stock picking. But Berkshire Hathaway is also this giant industrial conglomerate. It owns Geico, it owns the BNSF Railway, owns Dairy Queen, owns so many consumer and energy and insurance subsidiaries. The insurance side of the business is doing really well. And that's one of the reasons why operating earnings were up about 20% for the first 3 quarters of 2023. We'll be getting those fourth quarter numbers at the end of the month. And also when Berkshire Hathaway's Warren Buffett will release his annual shareholder letter that everyone will be scrutinizing to see what he says about the economy and the state of the markets.
And Paul, listen, you are a veteran financial reporter, so I'd be remiss, Paul, if I didn't ask you to get your take on the kind of market action we're seeing here today. There seemed to be this story, Paul, and we had any number of strategists who would come on and say, listen, the story is it's rare and tricky, it's a soft landing, inflation's cooling, the Fed's going to cut. You think that hot CPI print that we got today, Paul, did it kind of upend that narrative?
I don't know if it upended the narrative entirely, but I think it's certainly having investors worry about when exactly the rate cuts are going to be coming. I mean, it wasn't that long ago that some people thought a March rate cut was a certainty. That seems like an impossibility now. May doesn't even really seem as likely anymore if we keep getting numbers like this that show a pretty healthy economy with a job market that is continuing to show some steam. Wage gains aren't exactly evaporating. So I think that investors who had been banking on a rate cut sooner rather than later, now the best they can probably hope for is June. And more hot data could mean that it's further on in the summer before we get that rate cut.
And bringing it back to Berkshire, Berkshire is sort of known for weathering this kind of stuff pretty well here. We're going to get the 13F filings from Berkshire Hathaway and a lot of other funds coming up later this week. So we'll get more detail onto what the current holdings look like. You got any guesses, Paul? Or what, are we going to see the Occidental stake go up yet again coming from Berkshire Hathaway?
Yeah, I wouldn't be surprised to see the Oxy Petroleum stake go up a little bit. We know that Berkshire is very enamored with the energy business. Chevron is now a giant portfolio holding as well. But again, remember that Warren Buffett loves his Coca-Cola and Kraft Heinz. Those are 2 key core holdings in the portfolio. I'd expect that they'll probably stay steady there. Same thing with Apple. I'm not really sure there's much more for Berkshire to be buying there. So, keep an eye on whether or not some of those smaller positions get larger. Amazon, after all, is now, amazingly enough, a Berkshire holding. Whether or not that's more about Ted Weschler and Todd Combs' influence than Warren Buffett, that's possible. Snowflake, the software company, another tiny holding. So I'd be very curious to see whether some of these smaller, not exactly breaking the bank sort of positions go up in size as the newer guard at Berkshire exerts a little bit more control over the portfolio.
Paul, thanks so much for joining us today. I really appreciate it.
Thank you.
And coming up, closing bell on Wall Street, we're checking in on the latest market moves and the top trending tickers. Stay tuned.
There it is, the closing bell on Wall Street here on what has been a sell-off day. So let's take a look here as we settle out and see exactly where this sell-off is ending up. A little baby bounce off the bottom here, or maybe a little more than a baby bounce. The Nasdaq at one point was down by as much as 2.4%, finishing the day off by 1.8%. The S&P off by about 1.4%. It too was down by as much as 2% or so during the session, and the Dow finishing lower by about 1.33%. or about 524 points. So off the lows a bit, but still a broad-based sell-off and the sharpest sell-off that we have seen in quite some time. All of it tracing back to the hotter than estimated CPI data that we got this morning that led many traders to reduce their bets on the Fed cutting rates anytime soon, Josh.
Yep, sliding stocks and bonds, by the way. Yield on your benchmark 10-year up about 15 basis points today.
Yeah.
For more on today's market action, let's get to our team coverage with Yahoo Finance's Jared Blickery and Yes Ferre and Madison Mills. Jared, let's start with what is catching your eye today after January's hotter than expected inflation report.
Josh, it's all about the bond market, and I'm tracking the entire yield curve, which has shifted up. This middle line was where we were yesterday. This yellow line was where we were at the end of last year, and this purple line is where we are today. And when we get very quick movements upwards or downwards, for that matter, in the bond market, it can have ripple effects across the rest of the market. And let me just show you in the 10-year T-note yield where we have come from. As you said, up 14 basis points today. That is a lot for risk markets to deal with. This is a one-year chart, and late last year when we had that everything rally, we went down significantly, about 100 basis points there. But the net result this year is we are heading higher, and this is creating more volatility. Just take a look at what the VIX did today. This is now at the highest level in months, and you scale this down to a 5-day view, you can really see risk markets under the gun here. And we want to shift it over to Ines here, who's tracking sector action.
Yeah, that's right, Jared. And taking a look at the sectors today, we saw all 11 sectors of the S&P 500 in the red today. So let's take a look here. We watched as rate-sensitive sectors have been the ones impacted the most. You see XLY here down almost 2%, consumer discretionary. Remember that this includes names like Amazon, Tesla, Home Depot, McDonald's. When economic times are good, people flock to these companies. When they're bad, when they're not so good, they stay away. You also are taking a look at XLRE. This is the real estate sector, down almost 2% as well. Higher for longer rates impacting commercial real estate, expected to also impact residential real estate, or at least keep it frozen. You're also seeing technology that's in the red, but take a look at the sectors that lost the least. Defensive, meaning healthcare, the healthcare sector, and also the energy sector, down almost 1%, as today we saw WTI and Brent crude up more than 1%. And now with a closer look at tech, let's go to Madison Mills.
Yeah, and as you can't really talk about a big sell-off day like today without talking about where most of the market concentration still is in those magnificent 7 stocks. 6 of those 7 doing exactly what you'd expect in a sell-off day like today, down about between 1% and 3% depending on the name. The one that's the least big loser among those 7 is NVIDIA. And why is that? This is our AI play, right? It's continuing to get a lot of positive attention from investors. One friend of the show on X calling it the only stock that could beat the Fed when the Fed was proven right today in that CPI print. And that's exactly what we're seeing after the close here. As we come up on the close, rather, it looks like NVIDIA is going to end the day about flat. And that is something that we saw in the market action throughout the day. Every time that NVIDIA kind of went right into the red, we saw it correcting back into the green. I also spoke with Steve Sosnick about this name earlier today, and he said that NVIDIA is going to be critical to watch when it comes to earnings next week. We saw them beating across a lot of metrics in their last print, but that did not lead to positive market action for NVIDIA. So that could continue to pour cold water across the markets. Josh and Julie, I want to go back to you in studio.
Maddie, thank you so much, or should I say Maddie, Ines, and Jared, thank you so much for that full team coverage of the sell-off that we're seeing today. So for more on how investors should digest the sell-off, let's bring in Baird Managing Director and Market Strategist Michael Antonelli. Mike, what a pleasure to see you. It's been a minute. I guess when a sell-off like this happens, it helps to contextualize it, right? We haven't seen one like this in a while, it's true. But is it the start of something bigger, or is this just a one-day blip?
At least we have something to talk about, because the market's just basically gone straight up since January. So I'm excited that we get to talk about this, and I'm glad to be on with you guys again. That is the question that I'll write about, that I'll speak with clients about, that we will talk right here about is this the start of something bigger? And certainly there are indicators you should be looking at to wonder whether that's true or not. The dollar is one of them. You guys mentioned the dollar briefly. That will be something we will continue to need to monitor. When the dollar strengthens, stocks struggle. That's been like that for a while now. And technicians are keen to point that out. So I think you'd want to watch the dollar for sure. The VIX has got some quirks about it right now with options expirations and some open interest at certain strikes. So that's certainly had a crazy move today, but I think there's some options action there. I do think it's probably time for a pullback. I think it's time that you get one of your garden variety 5% pullbacks. And my friends, you get 3 of those every single calendar year, all of them.
And Mike, I'm curious how you think this might change kind of the narrative here. You know, there seemed to be a story. We heard from a lot of strategists, at least more optimistic ones, Michael, and the kind of narrative you heard was, as rare and tricky as it is, it looks like, you know, Jay Powell has engineered the soft landing, and inflation's cooling and the cuts are coming. When you saw that January CPI print today, and I guess, you see GDP and labor market and CPI, do you think maybe that storyline has been upended here?
Not only has it been upended, Josh, is it actually no landing? We talk about soft and hard. Is it actually no landing? There's also this view of trampoline landing. I think one of my friend Oliver kind of pushed that one out.
What is that, Michael? What is that? That is a new one for me. Trampoline landing. What is that?
I like it. I like it. It's this notion that we kind of hit the ground and then bounce right back immediately. Like we did have that kind of 2-quarter negative quarter back in 2022. We just bounced immediately. So trampoline, we're right back to 3% growth. I like either of those takes at this point. And CPI, as I've said many times before, years ago, I'm still getting no credit for it. This is like the end of World War II. This is not like the 1970s. And at the end of World War II, inflation hit 20% and came down, but it didn't come down in a straight line. It bounced its way down, and that's what's happening right now. Post-crisis, we're bouncing our way back down to 2%. We should not have ever expected it to go from 9 to 2 in a straight line. No landing, trampoline landing. I think we need to shift the narrative to those from soft or hard.
So what does all of that mean then for stocks, right? Especially coming off an earnings season where growth looks pretty good, and it's not just the Magnificent Seven where we're seeing growth.
Yeah, I think the narrative for stocks is still quite good based on the economy, based on all the things that were tailwinds from last year. Remember, this is an election year. That will certainly start to take all the oxygen in the room as the year goes by. One thing you would notice if you followed my work or some other strategist work is that the first quarter of election years are typically volatile. They're typically like this. You would expect the volatility to be in the first few months of the year. Why? Well, the market's still trying to come to grips with the candidates and the policies and all the things that surround an election. So this is not, frankly, all that surprising to me. I do think that the magnitude of today's move was eye-opening. It just goes to show people were ready to hit the sell button. But I think the narrative around where stocks can go this year are still quite good based on a bunch of economic indicators that are still strong. We're looking at 3% GDP growth, wage growth, all these things.
In terms of risk, though, to that call, kind of, downside risk, Michael, where do you put sort of geopolitics there? And are you in any way surprised, Michael, by the way, despite that, you look around the world right now, Russia, Ukraine, Israel, Hamas, Red Sea, markets have basically shrugged it off.
I get this. It's a good question, Josh. I get this question all the time in my career, all the time from clients. I get them live. I get them from friends. I get it all. Geopolitical events tend to have short-term impacts on the stock market. You could look all the way back to, I don't know, let's talk about the Cuban Missile Crisis. It had a very small impact on the stock market. Very, very small. That was basically the closest the world has ever come to nuclear annihilation. So geopolitical does tend to have very, very limited impacts. And I say to clients, Apple Computers still sells iPhones, and Costco still sells hot dogs, and Starbucks still makes lattes, even when there are hot spots around the world. And that's what you really, really need to focus on. So I am quite unsurprised by the market shrugging this kind of stuff off. What are the downside risks? An economic slowdown. That to me is the real downside risk, and I watch for it all the time.
Mike, I feel like you and I have even had this conversation before about geopolitics. Getting a little deja vu. Great to see you. Thanks so much for joining us. We really appreciate it.
See you, Joe.
We got some earnings coming out. We start with Airbnb here. Those shares up by 10%. And this is after the company's first quarter revenue came in ahead of estimates. Its gross booking value up 15% to $15.5 billion. That too coming out ahead of estimates here. And the company's first quarter forecast sees revenue of $2.03 billion to $2.07 billion. Analysts have been forecasting $2.02 billion. So if you look at those sort of high level metrics here, you're seeing the positivity and the positivity expressed in the shares. The company also saying nights and experience booked rising 12% year over year to 98.9 million here. And the company has been touting sort of the changes that it's been making to its experience. It talks about using AI. It talks about also doing more experiences. They talk about investing in underpenetrated international markets, now expanding in Switzerland, Belgium, the Netherlands. And they're talking about expanding beyond the core business and reinventing Airbnb.
Yeah, there's a few questions that I'm really interested to get on this call. First of all, the pop in the after hours is especially impressive when you think about the move the stock already made. It hit a 52-week high just this week, Julie. So impressive that it's keeping that rally going. I'm very interested in the call to hear about what they say about travel demand in 2024 and kind of where they see that demand coming from. Are there other opportunities looking ahead, maybe that are sort of under-tapped right now? Beyond the core, I think, hear CEO, Brian Chesky talk about what other new levers does he have to pull? And yes, of course, AI. Chesky is excited about AI. He's made acquisitions in that space. And so how does he think about sort of integrating that tech across his company going forward?
So you want to know where growth is? I can tell you a couple places where they are, where growth is. They tout the growth in first-time bookers, people who are booking on Airbnb for the first time. And that's quite interesting. And then the company also talking about growth in the international businesses, in particular touting what's going on in Brazil, where they saw high growth. So international markets is an interesting growth area for Airbnb. A couple of things to highlight there as we see those shares moving up in a big way, Josh.
Yeah, we got Lyft out too, so let's hit those numbers really quickly here, Julie. I see adjusted EBITDA 66.6 million. I see revenue 1.22 billion. That is matching estimates, so it's in line. Q4 rides 191 million. That's up 26% year over year. And I'm just looking for Q1 adjusted EBITDA. They're calling for between 50 and 55 million here.
Yeah, interesting here.
And that, by the way, is topping estimates, which I think helps explain what you're seeing here in the after hours.
Yeah, definitely. An outsized move. I was looking at this, speaking of outsized moves, I was looking at some data from Evercore ISI that suggests that the move that we have seen, both in companies that have beat on the top and bottom line and those that have missed, the reactions are bigger than they've been compared to the 5-year average. And here's yet another example of this big sort of outsized move that we are seeing here in shares of Lyft. You talked about the adjusted EBITDA numbers here, and gross bookings up 17% is interesting, especially given what we heard from Uber, which sort of seems to emphasize this is not a zero-sum game, that both of these platforms can continue to grow, perhaps.
Yeah, I mean, to your point, it was interesting going into this print. The stock was up about 15% over the past year. Rival Uber was up more than 100%, but certainly Lyft reports is getting rewarded here. Questions I'm interested. Driver supply, I'm interested in pricing. Could that be getting kind of more competitive? And its ad business, Julie. Remember they launched that kind of in-app advertising. Any kind of color and commentary you can get on that would be really interesting too. Because remember, we just heard from Uber, who now says they are already at a $900 million plus run rate on their ad business. So would love to see some color on there too.
Yes, we're going to get to all of that. But first, let's get back to Airbnb right now. Mandeep Singh, Bloomberg Intelligence senior analyst here, is joining us. Mandeep, just give us your sort of high-level reaction here to what we've heard from Airbnb today.
Yeah, I mean, they keep showing, more profitability in their current business model. I do think the room night number was sort of in line. So what that suggests is you are seeing some sort of plateauing when it comes to the room night growth. But overall, I mean, 30% EBITDA margins, that's why they announced, share buyback. So clearly they have no use of the cash right now than buying back their stock. And that's good for the sentiment. But I think at the end of the day, investors want to know what is the addressable market and where else can they move into beyond the vacation rentals that they dominate?
And that's a big question, Mandeep. So what's your answer there?
Well, so I mean, look at the other OTAs, Booking and Expedia. They do all sorts of, booking, whether it's rental cars, airline bookings, and that's lower margin. The take rates are much lower in that business, but what it does is it drives frequency. In this case, what you're seeing is Airbnb has the problem in terms of driving the repeat volume. I mean, how many trips are you going to book in terms of the vacation rentals you're going to book on the platform? And so that repeat rate is what they need to improve on. And that's where they need to expand into these ancillary, categories, which they haven't announced yet. They talk about experiences, but that hasn't been a meaningful contributor to their top line.
They're also talking about expanding into additional regions, right? They mentioned Switzerland, Belgium, the Netherlands. Is that going to be enough to move the needle in what you're describing?
I mean, for the next 3 or 4 quarters, they're going to face tougher comps. So look, they're a clear category leader. They have the brand name, and it's really in the results that they continue to expand supply in terms of individual hosts. So it's a great business model. It's just, the regional expansion is going to give you low teens growth, and they are maintaining that supply. I think the question remains around what drives that kind of pricing tailwind that we saw during the pandemic, and the tougher comps will really put question marks around their ability to sustain high teens to over 20% growth, which they have done since the pandemic. So I think we are at a point where it feels like the market is getting saturated for them somewhat, but they still have that brand and the category leadership in the vacation rentals category, and there is some runway over there.
And Mandy, we know Brian Chesky is bullish on AI. Gen AI made an acquisition there last year. How do you see him integrating that technology across his products looking ahead?
I mean, think of how we book travel, right? So right now you pick your destination, you pick your date, and the potential is that, Gen AI could change the way you book travel. And that's where they could be disruptive. At the same time, the moat that Airbnb has is all the fragmented kind of listings, the unique listings that you can't find anywhere else. And that's the part that it's tough for anyone else to replicate. You can change the UI in terms of how you book your travel, but you can't get those listings that quickly and all the reviews that come with it. So clearly there is a moat that they can sustain. The UI is most likely going to change when it comes to the booking of travel.
Mandy, thanks so much for joining us today. Really appreciate it.
Sure.
We've got much more market action ahead. Stay tuned. You are watching Yahoo Finance.
Former President Trump setting off fresh alarm bells in Washington and in European capitals with his latest rant about the NATO military alliance. Yahoo Finance's senior columnist Rick Newman here with more on NATO's defense spending target. Tell us about that, Rick.
Hey, guys. Right. So Trump is making heads explode again by saying that if Russia threatens some NATO member that does not pay what it is supposed to pay or spend what it's supposed to spend on defense, then he would not come to that nation's aid, and he would just let Russia do whatever it wanted. So I just decided to look into the economics of the NATO military alliance. This basically covers a group of countries in Europe that the United States has something like $1.6 trillion in annual trade with. That's the second largest trading bloc for the United States after Mexico and Canada combined. And we have about $3 trillion of direct investment in those countries. So we have an enormous stake in these countries in Europe. And Trump is right that there are about a little more than half of the member nations in NATO do not pay all that they don't pay. It's how much they're supposed to spend on defense. It's supposed to be 2% of GDP they spend on defense. And Germany doesn't do that. Spain doesn't do that. Belgium doesn't do that. Luxembourg doesn't do that. But guess who does spend that much on defense? The 5 nations that actually are closest to Russia and might be the first line of defense if Russia were try to go beyond Ukraine. So that is Finland, Poland, and the 3 Baltic states, Lithuania, Latvia, and Estonia. They all spend more than the NATO target of 2% on defense. So in a way, Trump is saying he wouldn't defend Germany, I guess, if Russian paratroopers landed in Germany. But in terms of the countries that are closest to Russia and most threatened by Russia, they meet the standards. So Trump's analysis doesn't apply. And, I think you can also just make a very good case that what the United States devotes to NATO is totally worth it because of all the economic interests it protects.
Rick Newman, we got you twice in one show today, Rick. That was great.
My lucky day, guys.
Thank you, Rick. Appreciate it.
Bye, guys.
A new book offering insight on how 7 former U.S. presidents searched for purpose after the White House. Today, we're talking to the author of that book about lessons learned from these presidential second acts. With us in studio right now, Jared Cohen, Goldman Sachs President of Global Affairs and author of the new book, Life After Power. Jared, it is great to see you.
Thank you.
So I'm interested, Jared, first of all, just given your sort of experience and background, you could have, Jared, written about any number of topics and subjects. Why this one?
Well, and you kind of have in past
And he
books.
has,
So
actually,
how did
yeah.
you pick this one?
The personal answer is my dad's a psychologist, my grandfather was a psychologist, so I was always interested in behavioral psychology. But the real answer is I've always been interested in this kind of elusive question of what's next. We get asked it so many times throughout our lives. And this is not a book about retirement. This is a book that takes the most dramatic transition in the entire world, President of the United States, where it's harder to top your last act than any other job imaginable. And when you look at these seemingly unrelatable figures and them coming back down to earth, what's left behind is a series of prescriptions and really valuable case studies for the rest of us.
And so as you were looking at these, what was the most interesting case study that people could kind of look at and draw a lesson from?
Well, so I look at 7 different presidents, and each of the 7 presidents had a totally different model for how they pursued life after power. And I think that in and of itself is interesting. It tells you that there's no blueprint for this. I think the one that spoke the most to me is John Quincy Adams. His presidency was an intermission between 2 of the greatest acts in American history. The first one was his parents basically micromanaging what he did, making him a president. His presidency was a disaster. And after he leaves office, he gets elected to the House of Representatives. And in a much lower station, after serving 9 terms, he achieves a much higher calling, which is he finds himself stumbling into being the leader of the abolitionist movement. And he takes a movement that was fringy and radical, and he mainstreams it just in time for Abraham Lincoln to take the reins.
And Jared, are there lessons learned from when you were researching and writing this book to kind of apply today in the election that we're going to have here in 2024 between Biden and it seems Trump?
Well, look, you never know what the news hook's going to be. These books take a long time to write, and I think the thing that's so interesting about the timing of the book coming out is it very much relates to this election. First of all, in 2024, we're going to feature what will likely be the only rematch between two presidents as the nominees of the major parties. Last time, and the only other time it happened, was 1892 when Grover Cleveland came back to challenge Benjamin Harrison. The difference then is he never lost the popular vote, and he'd never been happier than when he threw away the presidency in 1888. The difference this time, you have the two oldest presidential candidates in history, eclipsed only by themselves 4 years before.
And so, looking at the book and looking at what we're seeing now, particularly for President Trump, who's been not retired over the past few years, doing what he's been doing, still campaigning, and I'm also curious, in your work at Goldman, how you're seeing this election through the prism of your book and what conversations you're having in Washington and with clients.
Well, look, the first thing that I'll say, and I start off the book by reflecting on what the founding fathers thought about the idea of ex-presidents. Remember, they didn't have a lot of examples at the founding of Republic for the peaceful transfer of power. And Alexander Hamilton in Federalist 72, he asked the question, is it a good idea for the stability of the Republic to have half a dozen men or so wandering around the rest of us like discontented ghosts? So you fast forward to 2024, and we kind of have an answer to Hamilton's question, which is, ex-presidents can either be tremendous partners to their successors or they can be their most formidable adversaries. In terms of Goldman Sachs, I think what's interesting is, if you look at 2024, economists talk a lot about, an economic soft landing. On the geopolitics side, it increasingly looks like a hard landing. And the election features quite prominently into this. And while voters don't vote on foreign policy, the outcome of this election probably has a tremendous impact on foreign policy. And we see this from war in Europe, war in the Middle East, and the escalating tensions between the US and China. The election has kind of a too soon and a too far problem. It's too soon in the sense that all the different players in each of the three geopolitical theaters want more information about what happens in November before taking any drastic decisions. The problem is November is too far away for us to just sit back and twiddle our thumbs and hope the status quo doesn't sustain its volatility.
And Joe, I want to get you on this, just given your position at Goldman, another kind of geopolitical question for you. What are the geopolitical issues, Jared, that you don't think are being debated and discussed enough? We talk a lot on this program about, for example, the risk posed from China. It seems to be the one thing Democrats and Republicans actually agree on. What aren't we discussing enough, in your opinion?
Well, look, they agree on it, but Taiwan and the South China Sea get all the oxygen. People talk about military confrontation. What I'm worried about in 2024, which is something much more short-term, which is tensions and escalation around supply chains. The U.S. has called out a number of supply chains as being geopolitically important: critical minerals and rare earths, pharmaceuticals, energetics, microelectronics, to name a few. You can't decouple any of those supply chains. And so the question is, within each of them, where does the integrated economy stop and the diversified economy start? And there's a concern that if the geopolitical aspirations to diversify these supply chains exceed the economic realities of what's possible, you end up with a kind of tit-for-tat type situation and supply chain choking that happens in an election year. So while we talk about US and China, I'm not convinced that we're focused on the most important of the short-term issues.
Interesting. Jared, thanks so much for coming in. Appreciate it. Jared Cohen, author of Life After Power, president of Global Affairs and co-head of the Office of Applied Innovation at Goldman Sachs. Thank you. Still to come on Yahoo Finance, we'll take a deeper dive into Lyft's latest quarter with an analyst, plus a look ahead to DoorDash earnings later in the week. Woo, 41% gain for Lyft. Shares of Lyft riding higher and then some after the company posted better than expected adjusted EBITDA for the fourth quarter. The ride-sharing company also issuing upbeat guidance for gross bookings. Here to dig into the latest results is Rohit Kulkarni, Roth MKM Managing Director. Rohit, thank you so much for being here. Guys, can we put the stock back up here for just a second? We looked not 3 minutes ago, and it was up 41%. Now it's up 55%, Rohit. What the heck is going on here? Was this heavily shorted? I mean, I know they beat, but this is quite a reaction.
Yeah, this is quite a reaction indeed. I think this was just a case of heavy negative sentiment going in, probably heavily shorted name. People felt that there is going to be a lot of unusual activity in 1Q that is going to put an extra hair on 1Q results and 1Q guidance, and they come out, say they're beating on 4Q, all metrics are trending in the right direction, guidance in 1Q is better, they're hosting an analyst day in June, and 24 guidance implies significantly higher bookings growth than what Street is at. Just to put that in perspective, they think Lyft can grow high teens, 18-19% year on year in 2024 as far as bookings are concerned. Street is at 12 to 13%. So that's a very big gap. We just need to figure out how they get there. But the stock is up exactly because of the combination of these factors: shorted stock, negative sentiment, and really fundamental inflection.
So let me ask you, Rohit. So listen, you can see the stock surging here in the after hours. You're at a neutral though, Rohit. So you're at the sidelines. What would you need to see, Rohit, to put a buy on this name?
Look, I think just to put that in perspective, this company is somewhere in the range of 14, maybe $15 billion in bookings every year. When you look at Uber, that's probably 5 times the size when it comes to mobility. And Uber is growing something like 25% year on year as far as mobility. This company is growing 14-15% year on year. So Uber, which is much larger, growing at a much faster pace, much more profitable. Lyft, much smaller, growing at a slower pace, and obviously less profitable. So I think the valuation gap that we need to bridge here is TBD. We haven't seen a normalized valuation, normalized growth for either of these two companies. So that's where, what is the price we are willing to pay right now? Obviously, the company is much better today than it was 6 months back, but I think it's a price discovery problem right now. They're improving, but they're growing a lot slower than the bigger guy.
And there's also been sort of ongoing labor issues at these companies. In fact, we're coming into a day when we're expected to see a strike among drivers here. What effect is that going to have, and what does that tell us about how these companies are doing vis-a-vis their workforces?
I think it's a love-hate relationship between the company and the drivers. As in, the company loves the drivers hate to work for Uber, but they love the money. So I think it's always it's been a contentious relationship. I feel in a post-COVID recovery world where supply of drivers has been growing every month, the companies have been, absolutely no pun intended here, the companies have been in the driver's seat. By that, what I mean is they can and at will decide how much they are willing to pay drivers, either up or down, versus what they used to pay. And that's what's making Lyft and Uber more profitable, and drivers do not like that. So I feel there needs to be a balance at some point. Lyft has already put a stake in the ground by saying we are going to pay at least 30%. We are going to keep at most 30% of what the fare is going to be. So we shall see how that unfolds. But again, I don't see any particular reason why the relationship between drivers and the companies changes overnight, or at least over the next 6 months.
You know, Rohit, I've spoken to some analysts, some of your colleagues on the street, and you know, these are guys who cover Lyft like you, and they will say to me, Rohit, they'll say, you know what, even as somebody who covers this name, I'm actually not sure what the future of Lyft is, whether it's going to still be a standalone company or whether it's actually going to end up being an acquisition target. What do you think?
I think Lyft as an acquisition target, probably the likelihood of that rises with every day when they prove out their economic model. Like, believe it or not, over the last so many years, we have been using Lyft. We don't know steady state, how does the company sustain when it comes to generating cash for every dollar of bookings. So I think what they've shown in the last 3, maybe 6 months is they're taking a step towards that. And as they do that, they become more attractive for a company to get acquired. In my opinion, over the longer term, it's highly likely, maybe 2 years from now, Josh, if you're going to be talking, probably this is a company that is going to be acquired and probably is better off inside another app.
Interesting. And speaking of its biggest competitor, Uber, as you mentioned, is going to be having an investor day. What are you expecting out of that? And do you expect that it'll be a positive catalyst for the stock?
What's been the party line has been, we will discuss more about capital allocation and just the long-term strategy. By capital allocation, I think the investors expect at minimum buybacks. Like, let's see if Uber is going to be generating $1 billion, maybe a couple $1 billion of cash every quarter going forward. What do you do with that surplus cash, and how do you reinvest that for growth or return that to shareholders? That's one. And second is, remember, Uber gave out margin targets back in 22 for the next 3 years. They have significantly outperformed those margin targets. So now we are sitting here at 24 at a fork in the road, thinking how high can the margins go for a company like Uber in 25, 26 and beyond. So I think if they address that tomorrow, that would be a pretty big positive catalyst for the company, where they talk about margins and talk about profitability and how they see that unfold over the next 24 months.
And Rohit, I'll get you out of here with this one last name here, DoorDash. They report results on Thursday. Rohit, you're at a neutral on DoorDash as well. What do you think we're going to hear on Thursday?
I think at the current juncture, DoorDash is trading at a premium to Uber. By that, what I mean is they have a higher multiple and they are being valued more richly. And the oversimplified reason of that is DoorDash it continues to gain share in food delivery. I think for the stock right now, we think it's price to perfection, which in kind of layman's terms is they have a pretty high bar to meet right now. And what if they say that grocery, retail, and advertising, these are the 3 new layers of growth that they have been trying to tack onto the model, and those are kind of coming at a point where that are becoming more and more profitable. So if that's the case, then I think the stock goes up from there. Until then, I think they have a pretty high bar to meet on Thursday.
Rohit, always love having you on the show. Thanks so much for joining us today.
Thanks, guys.
And coming up, we're going to send it out to the newsroom floor to check in on the latest earnings results from Robinhood, Instacart, and MGM Resorts. Stay tuned. More Yahoo Finance after this.
Welcome to Yahoo Finance's group chat. I'm Alexandra Canal here with Josh Schaefer and Praz Subramanian. Guys, we have a lot of earnings crossing the wire in the last few minutes. And I want to start with Instacart. The stock is holding steady. The last I checked, shares were up about 2% in after. Okay, now we're up about 5% in after hours trading here. Now, we got a mixed bag when it came to earnings. They did miss on revenue. Looks like they beat on fourth quarter EPS. However, there are quite a few headlines that are sticking out to me. One, the fact that they are going to reduce their workforce. They plan to cut 250 jobs, or about 7% of its workforce, to focus on, quote, top strategic priorities. Now, this is going to be part of a larger restructuring plan. We also got news that the COO of the company will be leaving. Instacart is also known as Maple Bear, and this is something that I think we're going to be continuing to see when it comes to job cuts across the board. Earlier this morning, we heard from Paramount Global. They were slashing 800 jobs. And this is across industries, as a lot of these companies are pressured with interest rates high. I think that's something that we're going to keep seeing.
Yeah, I mean, it's the middle of February, and we've heard plenty about cost cuts since the start of the year, right? Cost cuts meaning people cutting back on jobs and trying to find ways to essentially be a little bit more efficient. And it has to do in some ways with maybe top line revenue not necessarily driving that growth to the extent that it has at different time periods. When you look broadly across earnings right now, what you're seeing from Instacart is not necessarily isn't a standalone, right? A lot of companies have not necessarily beat on revenue significantly this quarter, but this sort of brought to mind like a macro theme we're seeing right now in earnings, seeing Instacart probably, they haven't had the call yet, but they might use a word that we've been tracking, operational efficiency. Mike Wilson over at Morgan Stanley highlighted this word, essentially saying a lot of companies touting that being more efficient, right? Operational efficiency, he tracked in earnings calls, is at a 20-year high. It hasn't been
2023 was the year.
Mentions haven't been this high in 20 years. I should say it's not at a 20-year high. It hasn't been this high in at least 20 years. But basically the theory that a lot of companies are doing layoffs, a lot of companies are talking about layoffs and just how to protect those margins, because we know that's key right now, especially given rates.
Yeah, just noting here in their release about a GAAP net loss of $1.63 billion, which is about half their revenue. That's what it equates to, because of the fact they're saying that a lot of stock-based compensation kind of hit their books there post-IPO, so maybe that's a one-time thing. Maybe it's just like a thing that they're going to keep an eye on. You mentioned the job cuts, maybe that's part of that too. But they're expecting some growth this year too in the delivery business. So we'll see. I mean, it seems like a good business, but it's tough. We talk about groceries, talk about delivery, talk about logistics, and
a lot of competition in that space.
And you're talking about building efficiency. It's like, well, can they get more? Term called operating leverage that I heard recently about how if you can grow revenue and also grow profits, that's real deal, right? And the question is, can they do that? So we'll see if they can keep growing revenue, but then also can they get to that profit?
Hey, I used Instacart in college, but then when I got to New York, I did the Amazon Prime, Whole Foods. So like you said, the competition is intense, so we'll see what happens.
There's a lot of options out there. Let's take a look at another stock that is rising after hours. Robinhood swinging to a profit here in their most recent quarter. That's sort of the standout from this release. Also got revenue coming in at $471 million. That beat the street's estimates of $457. Crypto revenue coming in a little bit above. But again, I think, guys, the key thing driving the stock here is going to be that earnings per share coming in positive. Earnings per share coming in at 3 cents. Street had been expecting maybe a 1 cent loss. They lost 20 cents in this same quarter, or about 20 cents in this same quarter last year. So really just for a company that has been sort of, at least the stock hasn't done great, right? For a company to basically consensus beat on things like revenue, beat on profits, have those crypto revenues up, which is always interesting to see. Users not down significantly from a year prior, down about 4%. It just seems like an overall positive report for Robinhood from what investors wanted to see.
I mean, what S&P up 20%, not counting today, in the last 8 weeks, and plus you had crypto kind of rallying. I'm not surprised that there's more traders coming on board, especially retail guys who want to get in on there and start maybe getting in on the action, getting in on those nice gains. So I'm not surprised to see that's good for them. And I know you mentioned the media efforts that they're doing as well, right? So
yeah, they highlighted here other revenues increased 30%, coming in at $35 million, which again, when we're talking about quarterly revenue of $471 million, $35 million is not necessarily a small number, right? That's a relatively decent percentage there, or a percentage. And other revenues is highlighted by their gold subscriptions and also their investments in Sherwood Media. They're building out a little bit of a finance media arm over there. They just had some big announcements this week on new media reporters that they'll be adding. So I think that will be an interesting place to see if they continue to grow revenue there and sort of turn a little bit of a media business going also on that app.
I think that's definitely a growth opportunity there on the media side. And I know we mentioned crypto a few times, but we have Bitcoin hovering below 50,000, the spot ETFs out. You would think in the coming quarters that that's going to be a big driver.
They highlighted all 12 spot Bitcoin ETFs were on their platform within the day that they were launched, too. That was something they highlighted specifically in that release. We know Robinhood, I mean, they have a lot of traders on there that do go there to trade crypto. Now to have it even more accessible in the sense of those spot Bitcoin ETFs, I would definitely imagine that's an advantageous thing for their users.
Yeah.
Yeah, so another mover after hours here, MGM Resorts, reported record fourth quarter and full year results here. The stock is down after hours of 4% there. For the quarter, MGM reported revenue of $4.38 billion, topping estimates and adjusted EPS of $1.06 a share, again beating Wall Street consensus. The operator said Las Vegas Strip revenue of $2.4 billion in Q4 beat last year's totals, powered by that F1 race in October and increased gaming revenue. MGM China also doing well, hitting $983 million in revenue, beating consensus there, aided by the removal of COVID-19 restrictions in Macau, and they added a new gaming table. So just focusing on Vegas and the Strip revenue, I mean, I guess we shouldn't be surprised by that Formula One effect there, that whole week of just people, it's like hundreds of thousands of people coming to the Strip. I mean, they're used to that kind of volume, but that's a little big deal. And also, the Super Bowl happened just last week, so that could be another big kind of catalyst for them next quarter.
Sphere, Super Bowl, the Netflix Cup, that live golf tournament was in Vegas. It seems like everyone is going to Vegas these days, and this seems to be the new hotspot. And MGM, I think, would be a huge benefit.
I think it's something that you'll probably hear more about on that earnings call, right?
Right.
But it's what are the full expectations from last week, essentially. I'm sure they have a relative idea of what bookings were like last week, what that looks like moving forward for that current quarter. That seems like it would probably be huge for them. And then also when you think about MGM, one of the things that MGM has and like a Caesars has that some of the online sports books that we talk about don't have is the brick and mortar casino, right? Getting all of these people to Vegas for these sporting events, like an F1, like the Super Bowl, then you get people on the apps, they can then use it to go to a hotel, go to a real brick and mortar casino. I'm curious to learn a little bit more about how that sort of cross promotion is working for them, because that's a little bit of a strategic advantage for MGM, which their sports property is BetMGM, a little bit of a smaller player in the space compared to DraftKings and FanDuel, but they have that kind of different offering. And sort of how are you leveraging the Vegas boom, I guess, is one of my looming
and brick
questions
and mortar to drive that part of the business.
Right.
Yeah, no, that should be really interesting on the
And then
earnings
you have
call.
March Madness coming up too, right? Any kind of
A lot of sports. Sports isn't over.
yeah, exactly.
Oh, the sports betting never ends, guys. It never ends.
More betting.
Even though we're down on the Super Bowl, we could come up on March Madness.
We still have chance to keep sports betting, right? All right, but coming up, we are going to bring you what to watch tomorrow. We break down the stories you need to know to start your Wednesday.
Time now for To Watch Wednesday, February 14th. Starting off on the earnings front, Cisco, Sony, Occidental, Kraft Heinz, and Equinix all reporting tomorrow. Cisco's second quarter earnings coming after the networking equipment giant announced thousands of job cuts last week. And energy giant Occidental's report coming in a slew of deals in the oil sector. Shares of that company down about 4% so far this year.
Also on deck, Fed speak. Chicago Fed President Austin Goolsbee and Fed Vice Chair for Supervision Michael Barr will both speak tomorrow. Today's hotter than expected CPI print sparking a market sell-off and fresh speculation about the Fed's timeline for cutting rates.
And shifting gears to ride-sharing, thousands of drivers from Uber, Lyft, and DoorDash are expected to strike tomorrow on Valentine's Day over fair pay. The independent contractors accusing the ride-sharing platforms of taking disproportionately high amounts as commissions. Julie, what are you watching tomorrow? What else?
I'm going to be zeroing in a little more closely on those earnings from Occidental for a couple of reasons. It's been a fascinating story. CEO Vicky Holub has been leading the company and has, of course, the buy-in quite literally from Warren Buffett's Berkshire Hathaway, which has been steadily increasing its stake in the company. But investors are going to want more answers about Oxy's entrance into the recent battle for more shale property with its acquisition of Crown Rock. I believe the price tag on that was about $27 billion. And so the questions are going to be around how are they paying for it? She has talked about them quickly deleveraging any debt they get from it. So I'm going to be looking for more details on the call about all of that.
All right, I am watching Cisco. Reporting tomorrow. Stock over the past year has not done a whole lot, Julie. It's up about 4%. Most analysts covering this one are on the sidelines with a hold. I will note, though, that Amit Daryanani, well-known, well-respected analyst over at Evercore, he rates this one outperform. His target is 55, told his clients in earnings preview that the near-term outlook says challenging given enterprise networking weakness, but bullish messaging around the cloud and AI opportunities, he told them, could provide some support, even if they report weaker numbers. We shall see.
Interesting. We will see. And we'll be back tomorrow. That'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell. Have a good night.